Welcome to the Morrows Private Wealth Half-Yearly Update. This update highlights the key messages for you to take out of the detailed written investment report that we've recently prepared for you. Today we'll discuss where we are in the economic cycle, discuss the key themes driving markets, and provide an overview of our portfolio strategy and asset class positioning. Where we are in the current economic cycle is important because the stage of the economic cycle can assist us with making asset allocation decisions that will impact future investment returns. This chart from our September 2019 Investment Committee meeting showing the cycle position moving deeper into economy slows enters recession phase. Global economic data was deteriorating, corporate earnings were soft, and the sustainability of the current record-long expansion was being questioned. As a result, global central banks were aggressively cutting interest rates and increasing their quantitative easing measures. Several months later, and things have materially changed. This chart is from our January 2020 Investment Committee meeting, showing the cycle position has completely flipped back to recovery early upswing phase. Now, we do not view this as the start of a whole new cycle. Rather, the central banks appear to have extended the current cycle by 1 to 2 years. Accordingly, we expect growth assets to outperform defensive assets in 2020. For the year ahead, the reward to risk appears skewed to the upside, but being selective in investments offering the highest reward to risk is prudent given already high valuations and the length of the cycle. The X factor to this current view is the potential impact of the coronavirus. But for now, it's still too early to speculate on this impact. Central banks remain very accommodative, and their policies largely drove market returns last year. This chart shows that interest rates have just moved lower and lower over the past 3 decades towards zero. Canada has the highest cash rate at 1.8%, with Europe and Japan still in negative rates. In addition to aggressive interest rate cuts, central banks have also been aggressively expanding their balance sheets. This chart shows that after several years of deleveraging its balance sheet, the US Fed has added more than $500 billion to its balance sheet this financial year alone. And look what it has done to markets. The blue line in this chart shows the Fed's balance sheet expanding, and the red line shows the S&P 500 index rising. There is a strong link between quantitative easing and equity markets moving higher in the last 6 months. Have the central banks created and continue to fuel one of the greatest speculative bubbles in history? Time will tell, and that takes us to market valuations. Investors need to look at the current market and determine whether it is merely late cycle expensive, but still reasonable for the current low interest rate environment, or whether it is a bubble waiting to burst. We are arguably in an environment where market valuations are being distorted by central bank policy actions. Do you think that future long-term returns from US shares are going to be good when we are in the 96th to 100th percentile of historically expensive market valuations across a range of different metrics? Similar to the US share market, Australian share market valuations are arguably very high relative to history, particularly industrial stocks, which are trading 41% higher than their 20-year average, as shown in this chart. But this does not mean that share markets cannot go even higher, and it is our view for this coming year that share markets will move higher. And it's not just shares that look expensive. Government bonds carry much greater risks today than in previous periods, given current record low interest rates. How much lower can interest rates fall from here? The chart on the left shows that investors were well rewarded to have long duration government bonds in 2019 as global interest rates fell to record lows and central banks opened up the stimulus floodgates. 10 to 20% returns are not normal for defensive assets, but then these are not normal times. At some point, the value or protection that government bonds have historically provided will cease to exist, particularly on a longer term basis. The question is, are we at that point now given near zero and negative yields? The challenge for investors and asset allocators is that if government bonds are no longer considered defensive, where do you go for defensive investment exposure in your portfolio? The harsh reality is that the length of the market cycle and current valuations suggest that medium to long-term investment returns will almost certainly be lower going forward. In this table, Vanguard has simulated future 10-year return expectations for a range of global diversified portfolios. Let's focus on the balanced equivalent, which is a typical 60% stock and 40% bond portfolio. The median return expectation from this portfolio is 4.3% per annum for the next 10 years. A more optimistic 75th percentile expectation suggests returns could be as high as 5.9% per annum for the next 10 years, whereas a more pessimistic 25th percentile expectation suggests returns could be as low as 2.7% per annum for the next 10 years. The probability of meeting your existing long-term return expectations from a traditional diversified portfolio going forward is now much lower. The current environment arguably remains one of the most challenging ever in which to construct portfolios and have confidence in their ability to deliver returns that meet investor objectives. What do we mean by this? Investors need to make a choice when setting investment risk and return objectives. They can either accept a wider range of risks to generate their return target, or they can accept lower returns for a given amount of risk that they're willing to take. We outline here 6 different options for investors to consider based on the market outlook and long-term return forecast that we've discussed today. In our view, options 1, 2 and 4 are not desirable because they are unlikely to meet your future return objectives. Option 5 will work until it doesn't. Then your capital is exposed to significant downside risk. Option 3 suggests reducing risk and accepting lower returns. But if you combine this with option 6 and invest your cash into special niches such as alternative assets and absolute return strategies, then you can reduce market risk but not necessarily have to accept lower returns over the cycle. This is our recommended approach. I will now discuss our views on how portfolios and asset classes should be positioned based on current valuations and where we are in the economic cycle. We have been holding low cash levels given very low interest rates. Our global currency exposure is neutral, noting that the US dollar will be a safe haven asset in a risk-averse market. Government bond yields at current levels offer little in the way of capital protection or yield. There will be a time to increase this exposure, but not yet. We are underweight to credit and need to see spreads widen before we would meaningfully reallocate to this sector. We have exposure to listed property and infrastructure sectors via our long-short equity funds. We have an overweight exposure to Australian long-short and equity market neutral strategies given their diversification benefits. We don't have any exposure to Australian or global long-only beta strategies given market valuations and the lack of downside risk protection. The exception to this is global emerging markets, where we have an overweight position given attractive valuations relative to all other global share markets. Emerging markets should outperform developed markets going forward. Liquid alternative assets such as managed futures will be retained to benefit from sustainable market trends in either direction. Illiquid alternative assets such as private equity, private debt, infrastructure and direct property will be reviewed opportunistically. Investors must be prepared to lock up capital to access these strategies, but in our view, there is generally an illiquidity premium to justify the lockup. The high-level themes discussed in this update and our expectations for 2020 are summarised in the following points. Central banks are manipulating markets and their recent actions have extended the current cycle. Valuations are expensive in all asset classes, but opportunities exist on a selective basis within asset classes. Expensive starting valuations mean that future returns are going to be lower. The next 12 or so months favours risk assets over defensive assets, and emerging markets are attractively priced relative to these other assets. Alternative asset strategies still have the potential to deliver strong risk-adjusted returns, and whilst there will be a time in the next 12 to 18 months to position portfolios more defensively, that time is not now. Finally, investors need to consider their risk and return objectives going forward as the future will not look like the past. We hope that you have found this update informative, and we thank you for taking the time to listen in. Please read the written investment report we have prepared for you to provide more context around the issues that we have discussed today. And please contact your advisor if you would like to discuss your portfolio in more detail. Thank you.